Assalamu alaikum and good day. I am Siti Aina A. Unte. In this part of our video lecture, we are going to discuss impairment and the recognition of financial assets. First, let us discuss the impairment of financial assets. At the end of each reporting period, an entity is required to assess whether there is any indication that an asset may be impaired, such as when its carrying amount may be higher than its recoverable amount. So this leads us to a question, is there any indication that an asset may be impaired? If the answer is yes, the entity shall measure the amount of loss as the difference between the carrying amount of the asset and the present value of estimated future cash flows discounted at the financial asset's original effective interest rate. The carrying amount of the asset shall be reduced either directly or through the use of an allowance account. The amount of the loss should be recognized in surplus or deficit. The carrying amount of an asset is recognized in the balance sheet after deducting accumulated depreciation and accumulated impairment loss. Furthermore, in the case of accounts receivable, the allowance for impairment shall be provided in an amount based on collectibility of receivable balances and evaluation of several factors such as aging of accounts, collection experiences of the agency, expected loss experiences, and identified doubtful accounts. We have here an example of an adjusting entry to recognize the impairment loss. Given is the impairment of accounts receivable amounting to 1,000. An impairment loss is recognized and accrued through a journal entry to record and reevaluate the asset's value. It is recognized through a journal entry that debits loss and impairment and also debits the asset's accumulated depreciation if there is, and credits allowance for impairment to reflect its new lower value. If the loss on impairment is not given, then we can compute it by subtracting the new fair market value and current book value of the asset. In effect, the loss will reduce income in the income statement and reduce total assets on the balance sheet. So the adjusting journal entry to recognize the impairment loss on accounts receivable is debit impairment loss dash loans and receivables amounting to 1,000 and credit allowance for impairment dash accounts receivable amounting to 1,000. Another example, impairment of loans receivable from an LGU amounting to 50,000. So to recognize impairment loss on loans receivable from LGU, we have debit impairment loss dash loans and receivables amounting to 50,000 and credit allowance for impairment loans receivable local government units amounting to 50,000. Now let's discuss the derecognition of financial asset. Derecognition is the process of removing a previously recognized financial asset, liability, or equity from the statement of financial position. An entity shall derecognize a financial asset when and only when A. The contractual rights to the cash flows from the financial asset expire or are waived, or B. The entity transfers the financial assets provided the following conditions exist. First, the entity transfers substantially all the risk and rewards of ownership of the financial assets, and second, the entity has not retained control over the financial assets. Also, a gain or loss can be recognized from assets derecognition, though a gain on derecognition cannot be recorded as revenue. The gain or loss on derecognition is calculated as the net disposal proceeds minus the asset's carrying value. The derecognition of financial asset is subject to the provisions of Presidential Decree number 1445 on the writing off of receivables and other policies issued by the COA. Shown in the slide is the decision tree on the recognition of financial assets. We begin with the question, have the rights to the cash flows from the asset expired? If the answer is yes, then they recognize the asset. But if no, this leads us to another question, has the entity transferred its rights to receive the cash flows from the asset? If the answer is no, then has the entity assumed an obligation to pay cash flows from the asset that triggers the recognition? If the answer is no, then continue to recognize the asset. But if the answer is yes, has the entity transferred substantially all risk and rewards? If yes, then they recognize the asset. But if no, has the entity retained substantially all risk and rewards? If yes, then continue to recognize the asset. But if the answer is no, then another question is, has the entity retained control of the asset? If no, then they recognize the asset. But if yes, continuing involvement in transferred assets. So for example, an LGU paid its outstanding loan balance amounting to 1 million to an NGA. To recognize receipt of collection of the loan receivable from LGU directly credited to the NGA's bank account, we have debit cash in bank dash local currency current account amounting to 1 million and credit loans receivable dash local government units amounting to 1 million. Then to recognize the recognition of the loan receivable from the LGU, we have debit allowance for impairment dash loans receivable local government units amounting to 1 million and credit loans receivable dash local government units amounting to 1 million. To further understand this topic, we have here a comprehensive example from the book. Entity A government hospital, receives promissory notes from several patients amounting to 1 million. To recognize receipt of promissory notes, we have debit notes receivable amounting to 1 million and credit hospital fees amounting to 1 million. At year end, it was estimated that 300,000 notes are impaired. So in here, we are going to use the same performa entries that I have provided in my previous example. So to recognize impairment of notes receivable, we have debit impairment loss dash loans and receivables amounting to 300,000 and credit allowance for impairment dash notes receivable amounting to 300,000. A subsequent audit reveals that 100,000 of the impaired notes cannot be collected anymore. The COA authorizes the derecognition or write-off of these notes. So to recognize the derecognition of notes receivable, we have debit allowance for impairment dash notes receivable amounting to 100,000 and credit notes receivable amounting to 100,000. In government accounting, the recognition and impairment of financial assets is also reflected in the notes to financial statements. So here it is, just to show you how it looks like. I got this in the GUM for NGAs or the Government Accounting Manual for non-government agencies. That's all. Thank you and God bless.